Hi, I'm Ross from Coon Smith Accountants in Hamilton. I'm going to talk today about the simple numbers, looking at how the numbers work on this rental property and what's the loss going to be for you. How much is this property going to affect you? So I had a quick look on TradeMe, and looking at the first property that I could find, I found one on TradeMe. It's a Hamilton property. I'm based in Hamilton, so it's easy for me to find. It's in Norton, which is not a great area of Hamilton. It's in Breckens Ave. Price to move quickly, $370,000, and it's got the rental appraisal in there so that we can easily look at the numbers and so that we can work through those. So what I'll do now is look at a spreadsheet. How would I actually look at this property, and how do those numbers actually work out? How positive or negative is it? So the first thing I sort of look at is I've got an idea of what I think the capital gain is going to do in Hamilton, and to be honest, it's a complete and utter guess. I don't have a crystal ball either, but it's my guess based on history. So I'm generally working on the property market staying flat for the next few years, and then maybe towards the end of the 10 years starting to go up in value and going up. I'm expecting rent to go up a little bit, maybe 2% a year, inflation 3% a year. Interest rates are slowly moving from about 4% up to about 6%. So those are the assumptions that I've used. And if we sort of look at that on the graph, so a graph since 1996, so 22 years ago, property value 145,000 in Hamilton, 1996. So generally, property market goes flat. The blue line is Hamilton. It booms. It goes flat. It booms. So my guess in the future is basically it's going to go flat and then booms again. If we look at the numbers for this property, so it was Breckens Ave in Norton and Hamilton. We're looking at buying at $370,000, and generally I would work on no deposit. The main reason is most people borrow against other properties. They don't have a whole lot of cash to put in, so they're really borrowing against their personal house. First thing we need to think about is how many weeks. So this property, not a great area, it's an older house. I'm thinking 50 weeks, and if I looked a bit more, it might even be less than that, but I wouldn't work on the whole 52 weeks. Rental appraisal, 390 to 400, so 395 in the middle. The gross yield is basically the rent we're expecting for the year. In this case, 19,750 divided by 370 purchase price gives us a 5.34% gross yield. It means it's going to struggle to pay the interest. It's definitely not going to pay the rates and all the other costs, so it's going to be a negative property. So I've put in some accounting, I've put in bank fees, I've put in insurance. At the moment, I'm working on 4.5%. Yes, you can borrow less than that, but really 4.5 is not a bad interest rate, and some new investors struggle to get really good interest rates. So we'll work on 4.5, and it's the interest only, not the principal. Added in the property management, I've added in rates. Make sure you put in fair repairs and maintenance. So this is a property, older property, it's going to need painting at some point. So there's going to be more costs. I would probably actually go 2,000 at least a year, so 20,000 over the next 10 years. Now, some for seminars, you might join Waikato Property Investors Association or other New Zealand property investors associations around New Zealand, and you're likely to travel to the property. So this property, we're looking at almost 20,000 income, 26,000 of expenses. We're looking at losing about $6,000. And that's a pretty average house. It's just a stock standard house in Hamilton, nothing special. If interest rates go up to 5.5%, interest goes up to 20,000, our loss goes up to about 10,000. Then we look at what sort of chattels were to be in this property. How much can we depreciate? Carpets, curtains, dishwasher, stove, and heat pumps. It's an older property, so you're probably not going to get a huge amount of chattels, but it does depend on what chattels are really in it. And so I look at carpets, curtains, dishwasher, stove, and heat pump as the main five that I look at. This basically moves our cash loss plus the depreciation up to a 7,800 tax loss. At the moment, you can offset that against your personal income. So if you're earning 33%, we'll get a tax refund of about 2,500. Because you're losing money, offsetting against your personal income, you get about 2,500 tax refund. So the property is costing you 6,300, and you get a tax refund, you're really putting in $3,764 or $72 a week. So what do you think at that stage? Do you think it's a great rental and you should be rushing out and buying it? Or do you think that it's average, or do you think you should run a mile from it? So what I look at a bit further is then the 10-year picture. Sorry, the 10-year picture is a bit harder to see on your screen. It runs a little bit wider, and we've got a little bit smaller numbers, but hopefully you can read them. So the property is worth $370. We're expecting it to slowly go up in value, and about 2028 to be worth $565,000. So we expect it to go up. We expect the rent to slowly go up over time from $19,750 up to about $24,000. We expect all the expenses to increase, and I've worked on an interest rate of 6%, so interest costs have gone up. So a cash loss was $6,000, now it's up to about $10,000. Depreciation is going to get less and less over time. Tax refunds, we're expecting ring fencing to come in. We're not sure exactly the detail, but most likely it is going to come in. So we're expecting the tax refunds to disappear down to zero. So what happens is an overall picture, if we look over 10 years, this property is going to cost us $95,000 of cool hard cash to put in over the next 10 years. And we're hoping or gambling it's going to go up $195,000. So looking at that, over the next 10 years, you're going to have to put in $95,000 of cool hard cash after tax refunds. Do you think it's a good rental? Do you think this would work for you? You're hoping it'll go up, or I'm hoping it'll go up $195,000, but that's obviously a gamble. No one knows the exact answer. So to me, this property is very, very average. If not, I would run a mile from it. It's not in a good area. It's not a good house. Unless there's a subdividable potential or something that I can't pick up easily from the trade me ad, it's going to cost you a lot of cash over the next 10 years if you're a normal investor and you're borrowing the money. So my question would be, why would you do it? And when you're looking at buying and rentals, you need to look through the same things. You need to look at the gross yield. How good is that gross yield? What's the cash flow going to be overall? How much money are you going to have to put into a year? What's the impact of that if interest rates go up and if ring fencing goes away? So I look at that over a 10-year picture, and it gives you a lot more information. So hopefully that's really helped you and given you some valuable information. Make sure you like our Facebook page. A lot more videos and information up there, and also a lot on our videos. Thank you very much.